Okay. We welcome to all the participants for this virtual CP meeting. On that one is particularly, if you look at that one is how to pitch and all these things is there in this startup, how to pitch and how to get at the investors. On that particular aspect, we have with us CA Jia Diwan. CA Jia Diwan is chartered accountant with 20 years of progressive journey. In that one is particularly progressive journey and in internet companies and startups in India. And as well as whenever we are talking about the having initially developed between banking and strategy consulting, she started out that one is consulting and the corporate journey in 2011. And that one is consulting and clients in merger and acquisitions and business expansions and IPOs at PwC, RGP, and Moody's. She gained the precise aptitude to support the corporate in their journey of value creation. She joined the team ITZ case, where she took up her first major challenge in 2011 to create value for India's first digital payments company that proved to be a precursor to introduction of 30 trillion digital payments industry. And that one is, if you look at that one is particular aspect in that specialized in that field, merger, acquisition and corporate finance and private equity. In 2016, she has joined Musafir.com. In parallel to her primary roles and responsibilities, she actively advised startups, strengthens their business, operational strategy, explore strategic alliances to accelerate growth and raising the growth funds. She is very active across the startup ecosystem in India and is a member of various forums where she is involved in mentoring digital startup and nurturing the entrepreneurship. In addition, she also advised ventures on accelerating their journey to commercial success. She is an organization builder and strong leader known for starting off and scaling business through vision, intuition, technology, and user experience know-how. With this, we welcome to CA Jia Diwan for that one is for this session. With this, I'm handing over the session to CA Jia Diwan for that one is particularly on the startup pitching. Thank you, ma'am.
Thank you, Dr. Sambit. Thank you very much for a detailed introduction. I think now people will know, the attendees would know that I come from extensive experience with the startups. And that's an interesting field, actually. And this is also a very talk after field, I would say so, because startup world is in the news every day. Whether you open any digital forum or you open any newspaper, there are a lot of stories which float around startups, especially, stories with respect to how startups are becoming unicorn across the country. We just crossed 100 unicorns in our country, right? And how they are creating value, how they are bringing in change in the country, how they are bringing in social impacts, how they are actually changing the face of a lot of industries. Right. So startups are a segment which everyone is right now looking at, tracking, feeling inspired, aspiring to be startups. And I'm sure there are participants here as well who are either entrepreneurs themselves or are aspiring to be entrepreneurs and are very close with the startup ecosystem in India. I must say that this is the right time to be in the Indian startup ecosystem, in whichever form it is. The contribution can come in any form, whether you yourself are an entrepreneur or you are part of the entrepreneurs team. This is the right time to be here because the kind of innovation which is going on within the startup ecosystem right now is next to nothing, actually, which we had seen ever. There's a lot happening. It all started with Silicon Valley, right? We always used to say that whether we would ever be able to replicate what's happening in Silicon Valley, so much of innovation, so much of creativity, so much of new flows of ideas which used to come from Silicon valleys, all the investors of the world, be it venture capitalists, angel investors, family offices, private equity funds, FIIs, everyone used to just eye on Silicon Valley. This used to be a case 15 years back. Winds turned around, and Bangalore, to start with, in India, became one of the largest startup community in our country. Now, as we see, we have startups all across the country. In fact, Mumbai, NCR region, Chennai, Hyderabad, all these locations are coming across as actually incubators for the startups. So this is the best time, given the government's push, to be in India, to start thinking about starting something, bringing in innovative ideas. And I actually feel very proud to be associated with the startup world, because it's so exciting. When you meet these startups, you get to know so much, you get to learn so much, you get to see that what all is going on in people's mind, in the young generation's mind, how they want to disrupt everything which is happening or which used to happen. If we look at the way we used to walk and talk, that has completely changed. The way we used to transact has completely changed. The way we used to do our shopping has completely changed. The way we used to eat our food has completely changed. And thanks to these disruptive, ideas which startups have brought in. In fact, the other day I was reading during the launch of, the new app by Tata. I saw Mr. Chandra talking about that we consider ourselves as startup, and we want to work like startup. We want to act like a startup. So coming from the veterans of Tata Group, this kind of comment clearly indicates that everyone wants to be part of this startup ecosystem in whichever way one can contribute. So I thought, what best way would be to start my conversation with all of you, to speak about what is the most important part of the startup world, which is pitching. Because every startup, when they start their journey, they want to speak about it, right? They want to talk to people about it, not just investors. They want to speak about it with people around them, so that they get a kind of validation of their ideas, or they get more insights about their ideas, or to get to know whether someone else would also be interested in joining them. So that's when the startups start talking about their ideas even before they start working on those ideas. And that conversation about the startup, about their ideas, continue till the journey, till the end, starting from your ideation stage to when you really create wealth for all the stakeholders which you have brought along, as probably in the form of an IPO or a merger, right? So the pitch, the ideation which happens, starts from the beginning till the end of any startup journey, and it never ends. No matter what stage of startup you are, it never ends. You continue meeting investors, you continue meeting your stakeholders, you actually pitch your idea to your employees as well, right? As a startup, you have to sell your idea to any potential employee that, hey, look, this is what our plans are, and why don't you join? So it becomes very, very critical for a startup to know how to pitch, right? And I thought that should be today's topic for my conversation here with the intelligent people sitting over here. So I selected this topic, pitching the investors for the fundraise. I had to zero down this pitching piece, because when it comes to pitching, of course, you go and pitch to your, as I said, employees, then you go and pitch to your advisors whom you want to bring on board. You go and pitch to your potential board of directors, so that you can have an eminent board sitting and guiding you. So at every stage in a startup's journey, you go and pitch. You go and pitch to the regulatory authorities about your business. Now, that would have been a very, very broad topic, because every pitch has a different purpose. And if it has a different purpose, then the nitty-gritties of the pitch or the way you pitch changes. So I thought to confine it for this discussion today. I thought, let's do a pitching for the investors for the fundraise, because that's something which involves a lot of technicalities. right? And a lot can be made or broken with those technicalities. And I feel, as a part of my journey, when I have interacted within last 10 years, I think I would have interacted with many startup. I can count them in hundreds. I found that pitching, though, is seen as a very humble act, and it comes very naturally from the startups. The moment they sit, they meet someone, and the moment they sit, they start that conversation. That's what the pitching is, right? So it comes very naturally to them. But the person whom they are pitching, whom they are talking, what message they are driving becomes very important. So if you are not um, aware of the technicalities of it, probably you may lose out on the purpose of driving your message across to that person, and that person can be a very important person. And one of the most key people whom they pitch is investors, right? Because they are the ones who help the startup grow. They are the one who fund the startup. So it becomes very important for a startup founder to understand that if they are talking to investors, if they're pitching to the investors, what are the things which they should keep in mind? What are the do's and don'ts? And what is it that they need to do to make their pitch right? So that's going to be our topic for next couple of hours. Um, I will actually start with some basics here. And I'm sure, a lot of you would know it, but it's always required to see that how the stages of financing works in a startup world, right? So the startup starts with an ideation stage. I think I'm just stopping here for a while. I think we have been joined by CA Dr. Raj Chawla. Dr. Raj, can you hear me?
Yeah, good evening.
Good evening. So Dr. Raj Chawla is our Vice Chairman of the Committee on MSME. He has just joined in. Maybe I'll stop for a while, Dr. Raj, and would ask you to address the forum.
Thank you, Giaji. Good evening to all. At the outset, I am happy to be a part of this virtual CP meeting on pitching the investor for fundraise organized by the Committee on MSME Startup, ICI. We are thankful to all the participants and resource person CA Gia Dhawan for joining this virtual CP meeting. The Government of India aimed to create a robust ecosystem that would encourage the establishment of startup enterprises, resulting in long-term economic growth and large-scale employment possibilities. Though this effort, the government hopes to empower startup to grow through innovation and design. Since the announcement of the initiative on January 16, 2016, several projects have been implemented to support the Honorable Prime Minister's vision of changing India into a country of job creator rather than job seeker. These programs have accelerated the startup culture with the Startup India initiative, recognizing startup and many enterprises taking advantage of the launching e-business venture in India. CAs play an important role in the execution of any startup business model and revenue model. As partner in nation development, it is unquestionably not only a professional opportunity, but also a responsibility for the greater good. The boom in the startup ecosystem had caught the attention of chartered accountants, some of whom are seeking an equity stake for the non-audit services they offer. As per regulation, auditors are not allowed to pick up a stake in the company they audit as the question of independence come into the picture. Hence, many chartered accountants are into regulatory and compliance services, startup advisory services, and providing complete non-business support to a startup from a structure, business plan, corporate law, ESOPs, documentation, agreement, functioning to angel round. Startups get all the services from the chartered accountant, including ideation on technical grounds, incubation, and monitoring. The investing CA can see the upside of an investment if the startup make it a big. The chartered accountants can provide advisory and professional services in the field of direct and indirect taxation, PAN, TAN, GST, registration, equity formation, and capital structuring, and accordingly compliance with the respective regulatory authority and law in relating to shop and establishment registration, provident fund, employee state insurance, ESIC, professional tax, ROC compliance, RBI, and FEMA compliances, and any other applicable law. We hope that your enhancement of the knowledge in the startup ecosystem helps you in the future endeavor. Thanks and best of luck for your future professional and personal endeavor. Thank you, ma'am. Thank you for spending this valuable time.
Thank you, Dr. Chawla.
Thank you, ma'am. Thank you.
It's great to hear from you.
My pleasure. Nothing. Please continue now.
Sure. Okay. Moving on, I'm sure this is an interesting topic for everyone when we are talking about startup fundraise, right? I mean, every day a new unicorn coming in. I think this becomes very appealing for the younger entrepreneur who are actually aspiring and dreaming to create something and bring changes in the country. I take this privilege to actually try to share my knowledge on the pitching, the best way of pitching to an investor. Right. So we were on the financing stages, and so there are different stages in a startup. When you start your startup, when you start thinking about a startup, right, that's at an ideation stage. When you are just trying to assess the opportunity, what are the opportunities which are available there, which is based on your idea? What are the alternatives to that idea? What is the form which I will try to create as a startup? What is going to be my business plan? What is it that will bring me money to sustain and survive my idea? What is it which I will have to create to bring my idea to a startup stage? So these are the things which are there in a person's mind when he or she is thinking about starting a startup. It's at an ideation stage. That's where they also get an opportunity to raise the fund, which is called your seed fund or the angel fund, right? Once a startup receives a seed fund or an angel fund at an ideation stage, the way the startup functions is either they continue because they succeed in finding the business opportunity in the market, or they succeed in finding the strategic alternatives of their ideas, which they are going to implement then, and they also get to understand what form factor they would want to bring in the form of a company into the system, and what is going to be their business plan. If they understand that, they continue and go beyond the ideation stage. If they need any modifications, they do the modifications if they are getting to know about strategic alternatives, and they move on from ideation stage. If it gets stuck that already there is a saturated market of their idea which they are bringing in, or they are hitting a glass ceiling in terms of the product, probably the product is obsolete, then that's time when at the ideation stage the startups get abandoned. It doesn't go further. But fortunately, if it goes further, it moves into the R&D stage, wherein you try to develop your product with the fund which you have received from the seed fund, right? And then when you try to develop the product, you want to spend money on the beta phase testing, real-time testing with the consumers, real-time consumers. You want to bring in your marketing plan. That's the time when a later stage seed funding comes, or a venture capital funds come into picture, which provides a startup a R&D funding, research and development funding. Again, if you are able to showcase your capability in terms of your product and services, you continue with your startup. A lot of startups fail at that stage because probably they do not find the product market fit. We will speak more about product market fit in our later discussions. Once they move on from that stage, which is a very happy stage, but brings in a lot of challenges as well. The challenges in the form of, acquiring new facilities, understanding about, when I say facilities, thinking about or acquiring an office space, acquiring warehouse space, acquiring space for building their plants, building the plant and machinery, thinking about their marketing plan, executing the marketing plan, strategizing how this plan is going to convert into revenue and how the revenue is going to convert into a break-even path. That's when a lot of startups need funding to execute all these actionables, and they obtain fund. At that stage, a VC comes into picture, venture capitalist comes into picture. When they succeed on all these activities, they move on and they get into a further clear path of, I would say, revenue generating activity. The business plan becomes more clearer. The product market fit gets established at that point in time. They also understand that the product market fit is now up for innovations. More and more innovations or new services are required to be launched. That's when the early stage funding comes in. The later stage is a growth stage, which is what you typically read, right? So early stage is your Series A. Growth stage is your Series B, C, D, E, and I heard last was that the maximum amount of series a company has earned was Series G, and that was a record-breaking session actually, which I had with one of my fellow funding firm actually, and realized that of course there was a debate that should a company reach out to Series G, or should it not be ideal for that company to go for an IPO and M&A if they have already raised so many rounds of funding. But that's debatable. We will not get into it. But growth stage includes all your series of funding, B, C, D, E, and F, G, whatever, till the time you do not establish the business viability, till the time you do not build a real brand for your entity, and you are ready to give exit to all your investors who have come at different stages of your startup. And you either lead for an IPO at that stage, or a merger, or an acquisition, or a joint venture, right? That's the final goal every startup, I think, aims for. And if you look at a typical cycle in 10 to 15 years time, mostly in the US, the companies cover this cycle. In India, that is becoming a possibility, because now startups, with the regulatory changes, with the more liberal guidelines which has come from SEBI, now the startups also can get listed in our stock exchanges, and they don't have to look at US or somewhere else listing. So that's looking doable for our startup ecosystem as well. And I think that's very, very encouraging. I would just try to also give you a gist of that, what kind of sources of funding a startup can see at different stages. I would actually straight away jump into venture capital here, because angel investor is something which we will speak at length in the later part of our discussion. When it comes to venture capital, they are at a stage wherein you have already tested your idea, wherein you have already launched your product, and they come into picture. That's where a startup really establishes itself, because that's where the testing of market and product fit has already happened. Right? If a startup crosses that stage, then the chances of getting into the exit stage becomes manifold. And that's where the pitching to the venture capitalist becomes very, very critical, because that's where you are establishing what you have built up. You are validating what you have built up. You are actually proving that what you have built has the capability to create a viable business model, to take the investors to the stage of exit. And of course, there are a lot of other sources of finances apart from angel investor, venture capital, and private equity, which we will talk about in this. And I'm sure our fellow CAs would know more than me about the other sources of financing, because I have not very closely, worked on that, like sources of financing like trade credits and factoring. But those are also very interesting sources which a startup can look at for the financing. Of course, the way you approach for these financing are very different than the way you approach an investor for the financing. So we will stick to the investor financing in this discussion. Okay, so we spoke about angel VCP funds, right? These are different kind of stages wherein you reach out to these different set of investors. Now, how are these different? So when a company is in ideation stage or a seed stage, at a conceptual stage, has not derived any revenue at all, but has a visibility that how a business model should function if I launch a product or a service, that's when the angel investor come into picture. When you become little mature and you are at an early stage where you have already created a product, you have already created a service, you have already done your beta testing, you have proved your testing thesis, you know where would you go, where would you earn revenue from, or what are the sources of revenue going to be. That's where the VC fund comes into picture. Once you establish that stage and you move on to your revenue generation activity, you have clear path to your break even, you know your customers, you know your market, you know your stakeholders. That's when the late stage VC funds or early stage PE funds come into picture. When you are expanding into new markets or new products, or you are getting into the new level of growth wherein you have already broken even and you are actually eyeing on profitability, and you want to spend money in further expansion of your products in newer geographies, in newer products, PE comes into picture there for funding you further. Now, when PE comes into picture for funding you further at that later stage, right, where you have already established your business model, you don't need money for that to run your business because it is going on in a profitable mode right now. They bring in with a perspective that since they have already established themselves, they have the capability to make a business viable. When I say they, founders have the capability to make the business viable. This is the time I think I can have a confidence on this team and the already established business, that if I invest funds, we would be able to, along with the founders, replicate the same business success in probably newer geographies, in newer segments, in newer product categories, in newer service verticals. That's where they come into picture with a clear eye on the exit. Of course, all the investors come with the view of exit, but it's the most closest for the PEs when they come in. They come in to turn around the business completely. And they are very clear in their strategy that in 3 to 5 years' time, it used to be 5 to 7 years' time, when 10 years back, when I started interacting with PE, they used to come into any company to keep a horizon of 5 to 7 years of investment, sometimes 10 as well of investment. But now with the changing ecosystem and ease of getting listed in the Nasdaq and in the BSE and NSE, their views have changed. They come into picture now for 3 to 5 years time frame. Their horizon is very short now, and they want to take the company to the IPO or to a merger and acquisition stage. That's where all the investors get their exit. That's the stage when all the stakeholders get the value of the investment which they had made so far in the startup. Okay, so since it's a quite broad range of investors, which we just saw, starting from your angels to your VCs to Ps, within VCs, early stage VCs, late stage VCs, within Ps, early stage Ps, and your maturity stage Ps, and then comes the FIIs and FPIs for your IPO stage or M&A. I am actually confining this topic of our discussion to angel and seed and probably pre-VC funding to make it more crisp, to make it more, get more into the deeper discussion for the startups to understand that when they are reaching out to the investors first time, what are the do's and don'ts which they should do to ensure that you are cracking that pitch, you are getting that money which you deserve, you are getting that large check which is required for you to grow your business. So angel or seed investments, right? Now the question starts with many startup is that should we find out an angel investor or would an angel investor find us, right? It's actually, there's no scientific reason actually, okay, for this. So when a lot of angel investors are individual investors, are wealthy individual investors. They always invest in early stage rounds, which are smaller than the growth stage rounds, right? So in that case, they are always hunting for the new set of investee companies. Am I audible? Okay, I could hear my own echo actually. Am I audible clearly? Okay, sure. All right. Yeah. Sorry for the interruption. I could hear only my voice and I was surprised that whether you are able to hear that or not. Okay, so we were at that whether angels find the companies or companies find the angels. Now, with the social media, it has become very easy to reach out to anyone, right? Especially LinkedIn is the platform wherein you can find a lot of people. And I'm sure the startup ecosystem would have a general sense of how early stage investments happen. But if I'll put you on a spot, I'm sure we are not able to right now interact. But in the Q&A session, I might have asked you that if I'll ask you to describe the exact process, okay, how to reach out to angel investors and how to then take up your funding process, most would be, I think, hard pressed to come up with much details at all. So angel investment pitching is like cooking or like changing a tire, okay, or maybe playing a sport, okay. So it's simple, right? It sounds very simple. So the angel process is also simple in theory, but I must say a bit more complicated in practice, because you can see someone cooking and say that, hey, it's so easy to cook, but when you yourself go to cook, you understand that you need to know a lot of technicalities about it, right? Similarly, it's changing a tire. When you're looking at someone changing a tire, you feel that it's such a fun process, right? He did this activity in 10 minutes and it was such a smooth activity. I can also do that. But when you really go to do that, you really understand that there are a lot of technicalities which you need to know before you do this activity. And so is the case with sports, right? Now, angel investment process is also exactly the same. It looks very simple in theory that you reach out to them, you make your pitch, you share a few documents with them, and boom, it's good to go. But there are a lot of complications in that. The angel process, let me tell you, is not a rocket science, but there are a lot of steps and there are some complexities as well. And there can definitely be some signs to do some of these steps well to ensure that you are succeeding in this. And you are reaching out to, more importantly, you are reaching out to the right set of angel investors. So your search becomes more easy for the funding. Now, as I said, whether angels find companies or companies find angel, well, there is no scientific formula there. Angels have a way to keep their deal flow on. That's the typical term which they use, deal flows, right? It is primarily through their professional networks or through being a part of the startup incubator or angel investing platforms, or through participating in startup hackathons. So there are a lot of forums nowadays, right? I'm sure you might have heard about companies like IPVs, Mumbai, Thai, Mumbai Angels and venture capitalists. So there are a lot of such platforms which the angel investors use to hunt the right set of participants actually. Because, and then there are other modes like a lot of once you establish yourself as an angel investor, then you are known in that fraternity, and the companies reach out to you directly for asking for the funds, right? So these are the way of the deal flow generation for the startup, for the angel investors. Usually an angel investor evaluates about 50 to 100 startups for each single investment made. So that's the kind of number of companies they go through before taking one investment call. So you can understand the amount of deal flow, continuous deal flow, which happens at their end. That's the way for them to find out the companies. Now, how do you find out angel investor, right? It's easy. You can go to LinkedIn, you can search, and you might find a lot of it. But that's not technically the right way of doing that, because there are a lot of complexities which you should keep in your mind. A lot of angel investors, a lot of investors rather, not just angel investors, have their own thesis, have their own funds, have their own perceptions about certain industries, have their own likings and dislikings about certain sectors, right? So you need to actually shortlist based on what is best, which investor is best suitable for you to talk to, so that your strike rate becomes higher. Otherwise, you will end up having multiple such meetings in a day, and your focus on your business will get lost for that period of time till the time you're raising funds, which is not good for any startup, because focus on the business is a key factor at that stage of your business. Now, so angel group needs applicants, right? And they want applicants who meet their investment criteria. As I mentioned, they have criteria, right? Either they would want to invest in a certain sector, or they would want to invest in a certain kind of services. They turn down a majority of the applications because they get so many, and the founders should not use actually a lot of superlatives in their introductory email which they are sending. They should be very crisp and clear, so that the angel investors clearly understand that what this company is doing, is it really fitting into my investment thesis, and then quickly takes a call to whether meet the company or not meet the company, right? Nobody will be turned on by claiming that, I'm going to be the next Amazon, or I'm going to be the next Facebook. One has to be really confident and direct and realistic in telling when approaching the angel investor that, hey, this is what I do, and I'm looking out for a fund. That is the direct conversation I think the startups should do. Once you start doing that, you become more focused, and you reach out to the right set of angel investors for your investment pitch. Typically, let me tell you a little bit about how angel investors team work. Typically, in an angel group, the screening usually takes place once or twice a month. So there are a lot of such forums which we are part of. I'm sure you must also be part of. I am part of. So we usually actually once or twice a month, we evaluate, we screen all the applications which has come to us. And each of such application gets 10 minutes maximum, right? A screening committee of the group will hear probably 25 to 50 pitches each month. And when they choose 2 to 5 each month to present their startup at their investment meetings, it becomes kind of a 2 to 3% strike rate, right? So the founders have to be very prepared when they are coming and pitching, because it is good that they have crossed that first hurdle and have got shortlisted. But that 2 to 5% also, as I said, that out of 50 to 100, only one investment happens. So which means the strike rate is 1%. That's the stage where the startup should very clearly think about that. What exactly do I want to convince the angel investor about? So hence the startup founder has to be very, very prepared, has to put together a presentation like how you see on the Shark Tank, but it's not like a Shark Tank, right? So it has to be crisp, very crisp and punchy, and very clearly talk about what is it that you want to do. Questions will come up that you will need to be prepared to answer. But usually, a decision is not going to follow immediately. But the moment you say, what is it that you want to do, that will bring in a lot of clarity in the committee's mind. In fact, when you try to approach a angel investor group, there are many angel investor groups, who are using SaaS platforms. There are many groups like IPV, Venture Catalyst, um, uh, I'm forgetting few names, Mumbai Angels. Yeah, they actually communicate within the group using these SaaS platforms about their interest in individual deals. They indicate their interest levels and exchange comments about each of these deals. Now, in a lot of these platforms, entrepreneurs do not have access to the investor sides of the conversation, but some platforms also have sub platforms for entrepreneurs where entrepreneurs get to know about what the angel investors are actually evaluating. So they get to know what sectors they are interested in. They get to know the feedback about those angel investors, which has been posted by other entrepreneurs. So getting into those kind of platforms actually helps at this stage when you are trying to figure out that which angel investor you should try to reach out to you. It's good to understand what makes an angel investor tick, right? So if an angel investor, if you get to know from such platform or through your own market intelligence, if you get to know that if any angel investor is looking at has been evaluating, say, companies in EV space, or say companies in disruptive tech or AI space, then that gives you a clue that whether that angel investor is fit for you or not. And if they happen to be a fit, you would know what will tick with that angel investor. It's not the money they stand to make, actually. So let's look at the mentality of angel investors. They are not here in this game for making money. That's strange, right? Because we think the moment anyone is investing money, the clear idea is to make ROIs out of that. Yes, they do want to make a ROI, but that's not the primary factor for them. Because realistically, if you see, most angel investments fail, right? More than 95% of the angel investment fail, and that's a crude fact. But the angel investors are accustomed to losing their money, and they would rather not, but it's just a reality. They would not want to do that, but that's how the ecosystem functions, right? And angels, for the most part, if you have seen or you have noticed, are the successful entrepreneurs who have actually amassed enough money to use their expertise, now whatever, in whichever field it is, to be part of that disruptive new movement that's going on. Because they have already come out of their own, exited from their own startups. That's how they have earned money, and now they want to participate in other disruptive journeys which other entrepreneurs are actually bringing on into the ecosystem. They want to use their experience, they want to use their knowledge to be part of that exciting venture. A lot of them do not want to start their own venture. They want to be part of this exciting venture with many other entrepreneurs. And that's the reason they find investing through angel investment more viable compared to, having a direct innovation, a direct, startup at their own. And so that's, and knowledge to be part of an exciting venture with innovative maybe they want to make a fantastic score maybe once or twice in their angel career journey, right? Because if they are reinvesting that money in their own startup, then they are betting on only one startup. But if they are putting money in multiple startups as an angel investors, they can score more than once in their career, right? So that is what they are looking out for. Angels don't want to run any company, your company, as an entrepreneur. And no, they don't even want to steal the ideas. They are there excited about what is happening in the world out there, and can I be part of that? They want the founders to step up and make it a success, and they want to help. usually by serving on the board of directors, because that's where they bring in their expertise. They have seen every way a company can fail, and they want their investee startup to be successful because they have attained that success. And that's what they try to bring in for the entrepreneurs. Most angel won't invest in a deal unless they have a really good feeling about the key entrepreneur, the key founder who is, because they also want to see whether they are able to develop the camaraderie with the startup founder wherein they are investing or not. Right. Some angel says that's the most important element. That if I click with the founder, then I will invest. So here comes then another jargon in the industry, that is it the jockey or the horse the angel investor is investing in. Now this is a very old debate, and everyone has a different opinion. But many investors believe very strongly that it's the jockey in which they are investing it. It's the entrepreneur in whom they are investing in the money, and not the idea. They can change the horse, they can change the idea. And in fact, they do. In a lot of cases, they do. They have done that. And there are a lot of live examples of that. They change the horse in almost every single deal you would see. And some of the greatest examples led to some of the biggest profits after the horse was modified, not necessarily changed out, but the horse was modified. Now, let's see an example. Zomato. Zomato would be a good example. So when Zomato started its journey, it started as a table reservation platform or restaurant identification platform. It was a small tech which they have built up. They aggregated, they listed down all the restaurants which were in the vicinity which they were covering, and a user can go and find out a restaurant. And if they happen to find out their favorite restaurant, they can book a table, they can reserve a table. That's how the journey started, right? It started with that platform, and now it is the largest food delivery and hyperlocal platform. Very different businesses, right? Very, very different businesses. It did not change the basic technology, what they started with. They build up over the same technology over a period of time, but the horse completely changed, right? Evolved completely. That's how the angel investors comes and help you do. Another example, if we want to take Amazon. Amazon is another iconic example, I would say. They started with online bookstore in India. If you remember, Amazon was my client when I was in PwC. The first time I went I went to their office, I was like, what are these guys doing? They had a complete startup culture, complete startup. There were people in shorts and chappals sitting in the office and working on their laptops. I don't know whether they had taken bath also or not, for how many days. And I was like, what is the kind of client I have got? And I was really upset with my partner that he has given me this client. And they were only into online books, right? And look at the way now they have changed. They are the world's most valuable brand, offering e-commerce, cloud computing, digital streaming, artificial intelligence, whatnot. So the horse changed, the horse evolved. That's what the angel investors come and do. They guide you, they guide the entrepreneurs to do that. And the jockey horse thing have made many hundreds of enjoyable hours of debates among the angel investor community. And there's no right or wrong answer to these questions. I have seen both. I've seen things where there was a brilliant idea, which might have been an accident, and an average team that made a fabulous return out of that average idea. And I've also seen brilliant entrepreneurs who had 2-3 bad ideas in a row, but made the third or fourth one work in wonders, actually. So I think there are some that are both, which is why I think the investors will continue to have this question, continue to have this debate, whether jockey or the horse. Now, there are examples of horses also, right? Now, if you talk about horses, there are the best example is Flipkart, right? The product is what it was yesterday. and the teams have changed, the founders have changed, the investors have evolved, investors have changed, but the horse remains the same. That's the perfect example of, is it a horse? Yes, that was a horse, right? So as I said, there is no perfect example, jockey or the horse. You need to decide how do you want to pitch, and we will touch upon that more as we go along in our discussion. Now, how do the angels decide which ones to work with, right? Mostly all angels go through some kind of screening process to separate the companies they do want to work from the ones they don't want to work from. Some solo angels may have firm criteria or a checklist they will follow, but many will be relatively informal and follow their gut uh, about which company to follow up on. Now, angels in a group or a network or a fund will typically put the deal through some kind of scouting or screening process, which is a formal process to check it to weigh, right? Now, if it is an individual angel investor, it mostly is their gut feeling. It mostly comes from the past experience which they have had. If they are coming from a fintech background, they understand fintech better, they try to bet more on fintech companies. If they are coming from service industry, they understand marketing and servicing and B2C and customer acquisition more. Their gut feeling always drives them towards those kind of ideas. But if there is a group, as I mentioned, there are quite a few group in the country now who helps in evaluating the startups. If there are groups, they bring in a collective intelligence. And when this collective intelligence comes in, then that there comes a formal process. So typically the process would involve, right, to check whether it is fitting with their investment focus area, because there are a lot of funds which actually comes in with a thought process that we will invest in a certain sector, we will invest in a certain segment, we will invest in a certain industry, or we will invest in a company which is actually bringing an impact on a certain sect of the society, right? So whether it is fitting into their investment focus area or not. Also, what is going to be the upside potential of the investment? They also try to find out any red flags or any showstoppers, because that becomes very important for them to understand that whether the founders have earlier also started something, how did it end, are there any red flags to these ideas or the founders or the management team. And they also try to see that, what is the relative attractiveness compared to the other options vying for time, money, and attention. Because typically these groups are asking the angel investors to put money which can be invested in the startup, right? So if an individual who is willing to invest is putting money in the angel fund, she would always want to evaluate that if I have an alternative, whether this investment is relatively attractive than an alternative, which can be either a stock market or bonds, depending upon the risk appetite. But of course, the relative alternatives also are high risk alternatives. That's when you can compare it with a startup investment, because startup investments are considered mostly illiquid and high risk factors actually. So they try to evaluate all this very formally. They have a committee. They typically form a committee. This process is actually in our startup world, in our investment community, is referred to as scouting or screening. So they do form screening committees or a deal flow committee which evaluates. But regardless of what it is called, it serves as the first filter for separating the potential wheat from the chaff, as you say, right? So once you get screened through this, that's when your real interaction with the investors start. Just doing a time check. So now, if the company has gone through that screening round and has crossed that, right, there comes the deal. So deal stages. Typical deal stages are any good basic process will include the following actually things which are just listed down here. Once you get introduced to an angel investor or an angel fund, you start your interaction with them. That's the initial pitch meeting is called. We will deep dive into it more during our conversation here today, that what is the initial pitch meeting and what all needs to be covered in that initial pitch meeting, what are the do's and don'ts, what you should and should not do in this initial pitch meeting. If the initial pitch meeting goes well and the investors are sold on the idea or product or service, then the founders get another chance to showcase the capabilities in a more detailed meeting with the same set of investors, probably with more additional team members. And that's called a deep diving meeting. Once you cross that as well, a due diligence phase starts for you. The goal alignments come into picture. Goal alignment is a very, very important part of any deal because it's very important, especially with the angel investors. It's very important to align your goals. Now, as we discussed in detail, that angel investors' sole motto is not their ROI, return on investment. They are looking out for helping the company grow in the way they want it to grow, right? So a lot of time the horses change, as I mentioned. So there has to be a clear goal alignment at the deal stage itself. Whether the passion whether the idea which the startup, the entrepreneur is bringing on the table, is the angel investor aligned with the same goal, or is coming with a thought process that I'm betting on this jockey, but I'm sure that I'm going to change this horse. Now, are you also ready to change that horse or not? Or are you really very confident that your own horse will take you to the next stage? So that's where the goal alignment comes into picture. I'm sure a lot of you would have watched Shark Tank. Now, in the Shark Tank, a lot of the sharks, as they called it, a lot of sharks actually, when they were looking at the pitch, when they were evaluating, a lot of them most of the time said that, hey, look, I would invest in your idea, and you will come along with me as a co-founder. I will take so and so percentage, but you will do what I want you to do. We will change this product. And I'm sure you might have noticed that. So that's the that's the place where you need to understand that whether your goals are aligning or not. And once it is aligned, I think put together, angels are the best investors in any startup's journey to take them to the next level and the next level and the next level, actually. So goal alignment becomes very, very important at this stage. Negotiation of terms. We'll not get into detail into that because that itself is a very, very vast topic, that how do you negotiate on terms. That also includes your valuation matrices, your multiples, your comparables, your relative analysis, and a lot more. So, but negotiation of terms is a very, very important factor which you need to consider at the deal stage itself. Solicitation of soft circles, which means that you need to understand that what are the terms and conditions on which the angel investor is coming at. Whether it is, so a lot of investors come at terms and conditions like they would want a discount in the next round when the VC fund is getting raised. They would need a board seat. They would need certain authorization in terms of getting the data and the financials from the organization. So there are a lot of such things, a lot of clauses which come into picture, and you need to be very, very mindful of that. Taking an advice becomes very important there. A syndication, what syndication you are getting into, And of course, the closure of the documents, your term sheets and shareholders agreement, or if it is through a convertible note, the right set of, documentations in the place and stuff like that. So this becomes kind of a hygiene list for a startup to understand any typical deal stage, I would say. So what are the materials required for this, right? And these are typically these, at the beginning, there are only really 2 documents the founder needs. Okay, 3 documents. One of them, actually, you need 2 versions. These documents are an executive summary, which we called teaser, and a slide deck. Now, slide deck and your information memorandum are more or less same. With the slide deck, you need 2 versions, a more text-heavy version, which is an information memorandum, which can be emailed, read, and understood without you explaining it to the investors. If you are giving them like a book for them to understand your business, understand your market, understand your strategies, that information memorandum works well there. And a more spare visual version intended to be used as a backdrop for a live discussion, like a management presentation. So this becomes 2 sections of 1 set of document only. Sending anything more than this during an initial contact with investors is actually just a waste of time. Even an interested investor won't read it. So you just need 1-pager teaser. You need some 10 to 15 slide of presentation, and probably a 25 to 30 slide of your information memorandum. I think that is good enough for you to do that. On the back of it, actually, you need to also have your financial model ready, because a lot of data goes from the financial model into these set of documents. Now, one very interesting piece, when I started this journey of fundraise, there was no concept of these videos and all that. We were not very digital tech savvy. We used to give them hard copies, or at the most send them the PDF versions. But now, of late, with this new generation entrepreneurs coming in, a summary video actually works very well. And I find them very, very informative and interesting, and very interactive and very engaging to understand a company quickly in a couple of minutes time. So the teaser, which was a traditional teaser, which used to be in a paper, also gets replicated in a summary video format for the investors to understand what really the company is doing at a ground level. So if it is a company which is actually into, say, for example, the latest one which I saw was the company for, it's a fintech. They have built a very beautiful product actually for teens, for them to start getting used to of digital payments, right? And they can't open a bank account, so there are products for them. And they had created this video actually showcasing that how a even 8-year-old is using this product to make its pocket money getting spent. So that clearly showed me on the ground what is happening, what the company is doing. It was much better than a paper teaser. If I would have I would have probably not have been able to correlate what they are doing on the ground, but the summary video worked very well. So I think that's something which the companies are doing, entrepreneurs are doing that day, which works very well. So give it a try if you have not given it a try for that. Right. Now, teaser. Okay. The teaser is actually, is a 1-pager document, a very crisp document. So it's an executive summary, to say so, actually. And it includes most of the same topics which you would have in your basic slide deck. But the details must be very tightly packed and sparingly worded to fit on 1 page, or at the most the front page or the back of probably the same sheet. But typically it is just the front page which gets filled up with a lot of important information which the investors are looking at, like your key players, your company logo, your management team, your market, your market potential, your key numbers like your revenues, KPIs, and stuff like that. A little bit about competition, because that's the most you can fit it in, into one page. So one page, I understand, one page summary isn't easy, but it is a very, very important piece of document. When we were talking about these applications, there is the angel investors receives 50 to 100 applications in a span of months time. They take only 10 minutes to screen that, and they use typically these teasers to screen. And if these teasers are not very crisp enough to tease them, and hence the name is right, it's not quick enough to tease them, probably they would not take it to the next level, and they would not, it should generate curiosity in the mind of the investor to know more about your company, right? So I know founders may get incredibly frustrated trying to boil down all the information into just one piece of paper, but this has to be a very data intensive page. So a founder needs to and an entrepreneur should pay very, very close attention to how they are creating a teaser document. I am similar to, as I said, teaser, information memorandum or management pitch deck. Teaser was the shorter version of that. A more brief, detailed version would be this actually. Now, IM or pitch deck, both the versions, of the deck should contain the same basic material. It should start with your customer problem. It should start with your product overview, what the company does, for whom, why it's compelling, your key players in the market, your competition in the market opportunity, your market sizing, your go-to-market strategy, your competitive landscape, how do you stand, where do you want to shape up your niche market within the ecosystem of the competition, what are the stages of development you are at if you are into product development or customer acquisitions, critical risks and challenges, your financial projections, a crisp summary of financial projections, not the entire financial model, your exit options. This is very, very important. And I think I have seen in most of the IMs and management presentation, this piece missing, but this is very, very important. This definitely comes up in a Q&A. So if it is going to come up in a Q&A, it's better to address it upfront and tell the investors what are going to be the exit options. Something like what categories of likely buyers you are thinking are going to buy this, or the rationales, or the list of specific likely buyers or comparables or valuation multiples. All these data helps an investor to take a call quickly rather than waiting for the Q&A session or the deep dive meeting session. We'll get into, it's a new term I'm sure you're hearing, but we'll get into the deep dive meeting sessions as well. And of course, the funding requirement, that what is the requirement? How are you going to use that? What are your plans for how many quarters or years, or what period of time this fund would be enough for you till the time you become a profitable company or a cash generating company, or you raise another round of funding. That's about it. So these are the additional informations which actually are very, very essential for you to tell your story to the investor actually. So the key to this is actually to cover all the subjects. Okay, that's the formula, and wherein you have to attach all the strings together into a coherent and engaging narrative flow. You may have noticed that a discussion of teams actually becomes very important. In if you would have gone for pitches, you would have seen that investors actually talk a lot about teams. Now that becomes very important for any founder to explain it upfront, that who's the team, who are the co-founders, what is the management team, how is the team on the ground looks like, and that's how you need to make them build confidence on your company. And I would say visual presentation, visual presentation matters a lot actually. So while you're putting all this information in one set of document, just 15-20 slides or a 30 slide detailed IM, make sure that it is visually presentable when constructing a deck or a visual, any visual non-compatibility should be completely avoided. If you are not good at those kind of digital designing and all, hire someone to do that, because that actually makes or breaks the presentation, makes or breaks the pitch. If you are not, if as an investor I'm not able to stay focused on what you actually want to highlight, then I might get diverted and I might not be able to really think or get confidence on your idea. So make it very visual, presentable. Business plan is very important. Financial projections, though I mentioned that you need to put only a summary form of your business financials, but the founders need a business plan in order to do a good pitch, right? And you will need a very detailed financial model in the background and some part of the detailed business plan immediately after the pitch, because once the pitch goes good, they would want to understand the number. But these things cannot be part of your pitch. You need to keep that ready. The detailed financial model is a key part of the deep dive meeting, which happens at a later stage or a due diligence process. And the investor will want to dig into it and look at the assumptions in details, but it's not going to be part of this initial meeting pitch. So, it's very important that similar to a big MBA style business plan, which may have a lot of value and planning and analysis process, but it's just that a planning document is not a communication document. So you have to keep it ready. Like they say, plans are worthless, but planning is everything, right? So you need to do a clear planning of your financial model and keep it ready. So these are few things which I think every IM or a pitch deck should hold. Now, I'll take this quickly. So pitch deck, okay. Now we have seen what all is required for your pitch. But the pitch deck is actually, it changes based on what round of funding you are at, actually. The angel round or a seed round pitch deck would be different than your, let me do a time check to see if I can cover this up in detail. I think let's do it quickly. Okay. An angel round or a pitch deck would be different than your Series A round or a pitch deck compared to Series B round or a pitch deck or an IPO round and a pitch deck. Just to quickly cover your Series A round, your angel round, let's understand that the guy is coming and actually putting $500, $5,000 to $1 million, right? So their idea is to understand that what the idea is and whether the idea should be able to turn into a viable business option or not, right? So your pitch has to focus on that. When it comes to Series A round, you have already established your business idea, and you are actually serving the consumer. You are generating the revenue. You have the product ready. You have kind of done the product market fit. So which means you are at a much stable stage compared to what you were at the pitch stage for the seed funding round, right? So what becomes important for you then in the Series A pitch round is to see whether you are able to explain the or demonstrate how the product fits into the target market, or to show the investors how funds will enable the company to master a business model you have already established, but how to master that, and show the investors how more funds will lead to more customers quicker, because you want to grow the company. That's what you need to focus on when you are pitching. So the investor profile may change in this round. Some investors specialize in follow-on rounds, other in very early stage investment. Do your research, tailor your story to the questions of the prospective investors when you are doing a Series A round. When you're in Series B round pitch deck, it actually focuses on the scaling up of the business. You have a user base, you have consumer base, you have growing revenue, which has helped, which has been, due to the previous funds raised. New funds are used to scale the business model, make further acquisitions, and invest in the key capabilities. So these are few things which you need to start focusing on when you are at a Series B pitch round. It should be more mature view of the market, more mature revenue model, more competition, more understanding about the geographical expansion, more clarity on the exit scenarios. The focus should be on a sustainable growth model that drives the scale for the Series B, Series C, and D onwards down. Now, typically an IPO roadshow document, which is more similar to your Series D onwards round, wherein you are actually seeking fund to expand. You have established everything. You have established your brand. You have established the business viability. You have the set teams in place, products in place, services in place. Now you want to further expand, often to either new geographies or adjacent markets, or into the new product lines or the new service segments, right? At this stage, the company has been very successful and proven its viability. So you don't have to then, talk more about what you have done in the past. You have to just focus on explaining that what are you going to do in the new geographies. That's how the broad crux. And I rushed in this. I wanted to actually have a very long discussion on this, but I think in the interest of time, these four kind of pitch documents varies based on the focus area, based on the mindset of the investor whom you are pitching. Interesting piece. I wanted to move to this, before another time check. That initial pitch meetings we have been talking about. Now you have the understanding about what stages of investment, what stages of investors, what collaterals, what documents you need to have for pitch meetings. Let's talk about the initial pitch meetings, when you have cracked the introduction and now you are there for your pitch meeting with the investors. Now, pitching companies typically are introduced to the investors by a trusted source, and then selected, as with a lot of angel fund rounds also we have seen, and then they are invited to pitch as a result of making it through some of those screening processes which we discussed. Now, active early stage investors will look at anywhere from, as I mentioned, 50 to 100 companies for each company they invest in. And angels invest in a lot of company, but they say no to significantly majority of the company, right? So you can imagine the kind of angel investment news you hear, how many meetings they would be doing just for that one piece of news which we get to hear on in the digital platform, right? So screening actually is typically done by a committee or a subset of the investors of the network. So what you need to do for these pitches is, you need to keep in mind anywhere between 20 to 30 minutes for these pitch meetings, and another set of 30 minutes for the Q&As. Typically, that should actually help you in doing an initial pitch. Now, let's see, I just tried jotting down something for you, that how should your pitch flow go for any angel investor meeting. So let's explain the investor that there is a huge problem many people are really struggling with. There is a large demand for the right solution and it is not available. If you could solve it, you would have a great position in the interesting market, which is actually untapped, right? The perfect solution has the following attributes, A, B, C, D, E, which you think you can bring on the table for the consumers. We can produce that solution in a very cost-effective way as an entrepreneur is what you need to showcase it to the investors. Then our plan to bring those attributes to market is clever, differentiated, and defensible. Because if there are already existing players in the market, you need to highlight at this pitch stage that your plan is different than their plans, and your plan is defensible compared to what the competition is doing. As an entrepreneur, we know who our customers are, how to reach them, and how to bring them on board inexpensively. Because LTV CAC is a very important factor for any investor to look at when they are looking at the customer acquisition. So you need to help them understand what your strategy is in terms of bringing the consumers on board inexpensively. As an entrepreneur, you are super smart and have the right skills to execute, is what you need to highlight in your pitch deck. You will do it in the stages and will need certain resources to pull it off. How is your journey you foresee is also you need to explain it to the investors. And if you do, you can grow a large, fast growing and a very profitable company is the confidence which the investors are looking for, which will generate these kind of financials. That's where you will actually showcase your summary of your business model, and ultimately be of interest to the following acquirers. So you need to tell them the exit strategy as well, that if you come in now, these are the stage wherein you can actually think of exiting, because we would have new acquirers coming in at different stages of our journey as a startup. But at this stage, we need your help, and you can get involved on the following terms. That's where you can start the real negotiations with your investors. So if you keep this kind of flow, the initial pitch meeting, which we are calling, actually leads you to the deep dive meeting then. So let's also understand some key aspects of the pitching skill, that what exactly is something which you should not forget to highlight when you are pitching to an initial investors, right? So these are the critical areas which I have just listed down for you, where pitches are almost, if it doesn't include this, becomes shallow. Then these becomes a trouble spot. Explaining the market movement actually becomes very, very important. To be credible, a pitch must answer that why now, but market was not there. Why now you are coming and you think that you will be able to, capture this market. Now, what has changed in the universe that makes this business suddenly possible or not possible? What is that great idea which is going to change the market? So that market moment needs to be explained very clearly. I'll explain. This is a slightly complicated, moment which you need to probably explain it more to the investor. And I'll give you an example here to understand that better. Let's take an example of Policy Bazaar. Okay. So Policy Bazaar, we all know, right, what business they are into. Now, insurance companies were already there. RMs were already there. Most of the insurance companies have their associate companies as banks. So in the banks, those products were already available. The sales guys were already pitching those products, right? Products were available digitally, online, on the net banking, on the bank's website. All the details were there. Now, here comes Policy Bazaar and says that look, everything is there. A user can read whatever they want to read. A user can understand whatever they want to understand with the help of a relationship manager or the salesperson, insurance salesperson. But here is the market, that no one actually meets 10 different set of relationship manager to understand that which product is better for them, to understand which policy to buy, to understand what are the pros and cons and compare with each policy, right? That becomes a very tedious exercise. So here comes a market moment wherein, I am coming here and actually comparing whatever policy a user wants to compare and giving them a summarized result that, look, this is the best possible result for you, right? So here the Policy Bazaar actually very clearly understands that why me and why now. The companies were already there, the policies were also getting sold, but if I come here, I can disrupt the way the market is going on. And I think this is the right time, because there is no other player in the system right now who can do this. So you also need to find out, the way Policy Bazaar actually found out their niche. You will also have some or the other such kind of market moment for you. why your idea, why now your idea, is something that needs to be explained to the investors very clearly. And I think that's a very important tick in the mind of an angel investor, that yes, this is the company which I think can either disrupt or bring in more innovation in the already existing system. So that this point becomes very, very important for you to explain it to the investors. Second important point is detailing about go to market, right? A founder has to be specific about how they are going to crack their market. Selling is really hard, especially to a certain type of customers. So they're going to need to convince investor that they have a very specific and detailed plan or a business model, innovation that is going to allow them to acquire the so and so number of users, their intended number of users, and there is a customer affordability as well for their product. What they need to convince the investors, however, instead of convincing that I'm going to reach out to these many consumers and they are going to become my consumers, I'm going to acquire them, what is more important for them to actually explain is that why that user will get converted actually, and what is going to be the CAC LTV. CAC LTV explanation becomes very, very important again in go to market as well, because of the customer acquisition cost. That's again a big topic, and I'm sure most of you are expert in that. Maybe we can cover it up later if required, but that's a place where you need to make them understand that what is the CAC LTV, what is the detailing of the go-to-market strategy. Right? The third one, which I have listed down for you, is assuming fast consumer behavior change. Right? This is another important factor, because making assumptions about how target customers' behavior is magically going to change is actually not going to work for your investors. So if you're launching a healthy snack startup, say for example, or any digital payment startup, or any different marketplace, or any trading platform, the customer behavior is not going to change magically just because you have launched a product, right? You need to actually tell the laws of physics and gravity, that how you are going to change this behavior in the consumer. That's what you need to explain, and not that I'm just going to launch this product and consumers are going to buy. You need to get into that behavioral change magic and explain it to the investors. The next one in my list is paying insufficient attention to buying priorities. Now, that's a negative point, and I wanted this to highlight because a lot of times, as an entrepreneur, we, one might not talk about buying priorities. There's an insufficient attention to that. Certainly, someone will want the startup's product or services. But unfortunately, their immediately addressable market is limited to the people for whom buying their product or taking their services is a top priority. But for others, that might not be. So it becomes very important to explain them your total addressable market, your serviceable available market. So we call it TAM. I'm sure you are aware of those terms, TAM, SAM, and a serviceable obtainable market. That's called SOM. So TAM, SAM, and SOM is something which you need to really clearly articulate to your investors. Omitting the marketing skills, this is a very common thing which I have seen in a lot of presentations, that you undermine, the entrepreneurs a lot of time undermine marketing skills, which is your go-to-market strategy. The founders mostly are not an expert in marketing, but they try to showcase that they are expert in marketing and they are actually doing everything at their own. I think there's no harm in accepting that not all entrepreneurs are expert in marketing, and identifying the need to bring in the external people to help you in the marketing, right? So, and that's actually increases the credibility of the entrepreneurs, that they are, whatever they are falling short of, they are relying on the external resources for the marketing, because the right set of marketing actually breaks or makes your product life cycle. Then building a realistic model is very, very important. When I say realistic, I did not use the word intentionally, building the financial model. I said building the realistic model. And I'll give you an example here, probably, because this is a very long discussion that how realistic models should be prepared. But a very crisp example of this would be Nykaa. Now, Nykaa started with the cosmetics, online cosmetics store, right? And for 3 to 4 years, they had run only this online cosmetics store. Then there comes the pandemic, and they actually pivoted to a realistic business model, which included all the products like a marketplace, like what Amazon was doing, bought them into their store and started selling it. That's what we call a realistic model. So at whatever stage of your startup you feel that you need to be realistic and not just blindly driven by your passion about your product and services which you have built, you should actually look at a realistic model rather than a simple business model or a financial model. So this brings a lot of confidence to the investors as well. Assuming it will translate, yes, this needs to be also part of your pitch deck, that what you are actually planning in terms of how your business actions, how your strategies, how your execution strategies will translate into needs to be explained. Don't just showcase that you're assuming it will get translated. Showcase that you have actually factored in everything. What if it is not getting translated? How are you going to pivot? What are the various ways you would be able to diversify or do horizontal integration or vertical integration if something is not going to work? Because let's understand that this picture we are talking about is at an angel investment stage. And remember, we spoke about goal alignment. Now here comes the direct correlation with the goal alignment. So whether the action which you are doing, it will get translated to the result what you are thinking right now, and what if it doesn't do, what are the other options you have right now in your mind? When you discuss that, goal alignment exercise becomes very easy with the investors, right? Competitive advantage definitely is something which you should speak upfront rather than waiting for this question. And of course, exit scenarios. And I think I've highlighted that enough number of times, that discussing upfront the existing scenarios with the investors become very important, because again, with their goal alignment, it becomes clear that if they're coming here for the long run, what are the options they would have in terms of their exit. This interesting piece I wanted to bring in because I was not sure about, the profiles of the participants, but I think so impact investors are the ones like your CDCs, LFR equity, your IFCs of the world, who actually invest in the startups who are creating social impacts, right? Those who are working towards water conservation, environment conservation, for a lot of rural aggregation requirements. So such kind of themes actually, your hydrogen, fuel. So those kind of EV, those kind of initiatives actually are very thoroughly looked upon by the impact investors. And I thought if there are any, I would just quickly want to touch upon that. And I personally very much respect the entrepreneurs who are working in this area. So overall, for them also, overall process, overall the process of the impact investors is more or less similar. You need the similar set of documents, you need to go through the similar stages, but it does have some distinction. So the impact investors are still concerned with the usual investor questions, such as the viability of the business, the quality of the team, the size of the opportunity, the urgency of the problem, the viability of the solution. So all those questions which a typical angel investor would ask an entrepreneur, even the impact investors are looking out for those answers. This is because if the business fails or fails to grow, it cannot have a positive impact at all. And the impact investors' investment money could have been better applied elsewhere, right? So they actually are more stringent towards all this because they have a social cause, social impact purpose behind this, right? Unlike an angel investor who's not investing in an impact sector. However, in addition to the normal business evaluation, the impact investors are considering the motivation of the founders and their passion for the cause. That becomes very, very important because they are the ones who are actually not sitting there and deciding jockey or the horse. They are very clear about the horse. They understand that they need this horse, they are betting on this horse, whether the founder is passionate enough for that cause or not. They also look at the size and directness of the impact and social benefit. So and that social benefit should be aligned with their own social cause as well. That's what they need to see. So it actually kind of becomes slightly different when you're pitching that that when we were talking about having options for vertical integration, horizontal integration, diversification. If not this product, then what product? Have you evaluated the market? All those things actually takes a little backseat, because what you need to then showcase or highlight is that this is my horse. This is how I'm passionate about this horse, and this is how I am going to make this work for me. And that's what the social impact investors are looking at when they are evaluating any startup which is into an impact sector. Okay. All right. So yes, deep dive meetings. We will quickly do this interesting piece. We have 5 minutes to do, I think, if I'm not wrong, Dr. Sambit, before the Q&A sessions. But this becomes a extension of what we did in the initial pitch meetings. So when you are done with your initial pitch meetings, the screening is done, the initial pitch meeting is done, and now the investor is actually looking out for investing in your startup. That's when they call the founders for the deep dive meetings. The deep dive meeting is pretty much exactly what it sounds like, right? I mean, they deep dive into everything. It's a longer format meeting, typically 2 or more hours, to unpack the story in a little bit greater detail than can be done in a pitch. And there is no pitch document required in that, to be precise. If a pitch is a quick check for investors' interest, a deep dive is a chance to qualify that interest and see if there is enough substance to merit forming a due diligence team, because typically a deep diving meeting has larger set of audience. It would also have some analyst or the person who are volunteering for the due diligence from the angel investment fund. So deep dive meetings typically involve the investors most interested in the company based on the initial pitch meetings, and also the due diligence voluntary members for the due diligence team as well. So they have, at this stage, have seen that the themes are matching, have seen that the idea is matching. So what they need to do is that see whether the market potential is there or not. They want to deep dive into your team execution strategies, your product nitty-gritties, your technology which you have developed in more detail, and so on and so forth. So as we discussed in the earlier discussion also, right, that a good fundraising process progresses through a series of checkpoints, right? So you have screening, which is one, a successful pitch, which is another, and a deep dive, which is the biggest one, actually. Once you cross this hurdle of deep dive meeting, the funds are there for you. But there are some preparations which you need to do for your deep dive meeting, right? This is because, as I said, unlike your initial pitch meeting, so it's very key, and the preparation plays a very important role, and it is very different from the preparation the founder did for the initial pitches. So prepping for the pitch is a matter of rehearsing the presentation to fit in with the investors pitching section. While in the deep dive meeting, there is no pitch. It is not structured. It is less formal. The founder does not give a sequential walk through the deck of their own design, or their own pace, or their own sequence. Instead, she will mostly be reacting to questions on the fly. So there would be just Q&A sessions happening, no matter what type of agenda the investor or the founder tries to impose on these meetings at the outset. They always devolve into an unstructured Q&A meeting within about 10 minutes time. No matter how structured way you start, in 10 minutes, that is just like a back and forth Q&A session going on. And contrary to a pitch meeting, a founder will not be able to hide behind a slide deck or rehearse the flow, or, as I was mentioning, that what they're going to say, because the discussion topics will be random and will jump a lot here and there depending upon the number of people who are sitting there. So to successfully prepare, all founder can do is focus on marshalling the facts and the supporting material, and then study these materials so that you can converse in depth. You should know each and every part of it in depth. If you're talking about matrices like LTV CAC, you should know each and every part of it. If you're talking about your pivot tables, you should completely know how those are arrived at. If you're talking about business plans, you should completely know how you have arrived at those business plans. If you're talking about a certain target segment, you should completely know how you have arrived at that target segment. You can have lots of slides as an appendix, as and when any such question comes in, you can refer to that for more numbers or more details. But this is always going to go randomly. So I still repeat that the founder will not be able to give a pitch at this stage. The slide will only be there to help illustrate what the founder is responding to a question. But having those numbers handy always help. You need to deep dive before the deep dive meeting into all the facts and figures which you are going to talk about in that meeting, right? And you need to always be prepared to hit that tick for the I would say the investors, because you would know that if any question is coming in, you can always think that what you created, what you deep dived in the background to arrive at the answers which you are giving, that will give you more confidence about what you are going to pitch in the deep dive meeting. So typically, what kind of questions come in the deep dive meeting, right? And that's important for us to see here. Yeah. So questions which typically comes in are long-term company objectives, that you are investing at this stage. What are your long-term objectives is what the investors would want to understand, because they understood what your product is, your idea is, what is the team, and what your plan is. But now, what is the long-term company objective is what they would want to understand. They would want to understand the use of funds and aggressiveness of the investment level. It's a seed fund. So as we discussed, it would be $5,000 going up to 1 mil. Sometimes in some cases, it goes up to $2.5 million. But what after that? What is the aggressiveness of the investment level? How fast do you want to go? And how fast do you want to raise the next level of investment is what they would clearly want to understand. This again goes back to our goal alignment discussion, which we had for the investors. Long range financing plans and assumptions. So what are the long range financing plans and assumptions? Because this plays a key role, because angel investors, when they come in, even if they sign a small check, the share which they take as an equity is larger because they are taking the highest amount of risk. They are coming at a very early stage when no one has invested money. Founders might have invested money, but it is primarily about, founders sweat which goes into it rather than money which goes into it. So the majority of the investment is coming from the angel investor. So they take the larger, they pay the smallest check size, and they take the largest equity pie in any deal round, actually. So they need to understand that what are going to be the financing plans. If it is going to be an equity fundraise, their holdings will get diluted. So are there other financing plans available? And in the initial slides we discussed about those financing plans, like your venture debts and mezzanine funds and your factoring and bills receivables and stuff like that. So what are other those options available, so that you don't end up, so that the investor doesn't end up diluting at a early stage itself. So, and what are the assumptions behind that is something which is very much required to address. You need to be prepared to talk about that in the deep dive meeting. Exit strategies, clearly I need to talk about expectations on size and time, because you are an entrepreneur. You understand that you are not getting into this game only for creating valuation and exiting. You want to create something big. Probably you want to take this company to the IPO level in next 8 to 10 years time. So those expectation needs to be very clear, and hence the goal alignment comes into picture. So the last part of the a deep dive meeting is all about goal alignment, and you need, as an entrepreneur, one has to address all these things clearly with the investors before you sign the deal. A few challenging things I think you should keep in mind before we wrap up this session, and I open this forum for Q&A, that navigating the meeting. No matter, as I said, this is going to be a random meeting. No matter what question and answer and in what direction this is going, always navigate the meeting by communicating key 3-4 messages which you want to communicate to the investor. Always keep in mind that what are those key 3-4 messages which you want to drive to the angel investor. Whichever question comes in, ensure that you are weaving the story in such a way that those 3 to 4 messages are getting driven to the investors. Clarify what is being asked for. This becomes a lot of times showstopper, because if the entrepreneur doesn't understand the question and start giving wrong answers, these are the pitfalls actually. And start giving wrong answers, you might end up explaining something which the investor was not even looking out for or was not even there in their mind. You might end up opening a lot of can of worms there. So clarify, understand the question very clearly. If you have not understood, ask again, understand it. Also try to understand the question behind the question before you articulate your answer. Question behind the question. And if it takes time, ask again, so that you understand the question behind question, and then start answering to that. And last but not the least, building the confidence through repo. So the more repo you build, the more confidence you build with the angel investor at this stage, when they are ready to come and invest, it will go a long way. Because this, as I said, this is a journey wherein the angel investor will partner with you, will question you on the horse. Probably you will change the horse along with this angel investor. It's very, very important that you build that confidence and have that rapport with the investors. I think that's the end of my discussion now. I will open up for the Q&A session now, and I can see there are some questions which I have already received. Oops, quite a few. Okay, let me read it out for you. If an investor from Nepal is willing to invest in India, what is the process? Okay. So there is a new guideline, and I will not get into the nitty-gritties there, but there is a new guideline which has come up for AIF, and a foreign national can invest in India now in the startup as part of the angel funds. maybe we can discuss about it sometime later. Otherwise, you can also find out the new guideline on the AIF, which allows the non-Indian resident to invest in Indian startups up to a certain cap amount, actually. Whether the bank borrowing is possible for MSME as per the schemes framed by government. Yes, that is possible. And I think maybe we can pass on this question next time to our experts from MSME who are coming and joining in the next session, and they would be able to throw more light in detail. I'm afraid due to short of time, we would not be able to get into it right now. Brief contents of the pitch report. I think I covered that the brief contents of the pitch report, if you have, let me just keep that slide open if you are still looking at it while I'm taking other questions. These are the things which are actually should form part of your pitch reports. And if you're looking at the brief content, this is the one which you have to cover briefly. I'll move on to the next question. What is the expected investor sum that is expected from an MSME and startup? Can a person have an enterprise to raise funds and provide them to MSME similar to investment companies? Are there any particular clause of benefit to such investment companies set up to provide capital or funding? I'm afraid I'm not able to understand this question. Maybe I can come back to this question later. We heard about impact investors too. Are they different from the ones listed? So impact investors are actually, the funds who invest in the sectors which create impact in any economy. The few examples of that are IFC, CDC, Elevar Equity Fund. I mean, though they are equity fund, but they are very impact driven. So all their investments are impact driven. So there are such funds, and there are again some funds created by the CSR committees of larger corporates who actually invest in the social causes. So these are called the impact funds actually. And these are, if I'm reading the question, are they different from the ones listed? So these are actually the listed impact funds. They get registered as impact funds actually. And these are different from your angel investors, to be precise. Where and how to find angel investors? Is there any authentic forum, any precaution to be taken while negotiating, especially with respect to the confidentiality of the technology of product and services? So yes, there are a lot of forums wherein you can find angel investors. You can reach out to a lot of angel funds which are there in the country. They are registered as angel funds. Actually, if you look at IPVs or venture capitalists of the world, you can reach out to them because they invest in a group and not as a single individual angel investor. There are a lot of individual angel investors as well, which you will be able to find through the professional networks. And of course, some amount of precaution is always required in every discussions which you are doing with any stakeholders or potential investors. To mitigate that risk to start with, you can always sign a non-disclosure agreement with them before you disclose much details about your technology. The next question is, while talking to angels, we share our pitch decks. I think that's a question. So you don't have to share your pitch decks actually. But once you cross the initial stage, initial pitching, you actually need to send your information memorandum. And typically, a company signs a non-disclosure agreement with the angel investor before sharing any document. I'm just telling you about some practical aspects of it. There are no defined rules to it, but it's always good for a company to sign an NDA before you share anything. In the Shark Tank, we found the investors either over-exaggerating the idea or totally snapping the idea as not worth pursuing before rejecting any idea. So, okay. So that was a reality show, isn't it? And reality shows are supposed to be like that, right? In real world, you won't find that drastic behavior happening. Um, uh, if it's yes, it's yes. If it's no, it's no, clearly. In a deep dive meeting or such other meetings, how do the entrepreneur manage to keep the confidentiality of the spark, successfulness of the venture? Else, the other party may leak out the combination of factors of his venture to other person. How to manage the risk? So, as I mentioned, investors are not there to run your business or run your company or get your ideas. They are there to invest. When we talk about here, we specifically spoke about angel investors. Angel investors want to partner with an entrepreneur to be part of their journey, and they are looking out for more than ROIs. So they are not there to just take your idea and go and create. They are there to understand your idea and invest funds. Now, for all practical purposes, you should sign a non-disclosure agreement before you share any information with them. How does the angel investor platform perform the risk assessment of the entrepreneur, as the risk involved in investing in startup is very high? Yes, you are right. Okay, I can't see the names here, but yes, you are right. The angel investment, investment is the riskiest form among all the other stages, because you are actually investing. The investor is actually investing at an ideation stage, right, wherein there is no product, there is no service, there is no consumer which are acquired. So that's the most riskiest stage. But and hence the ticket sizes are lower, because the strike rates, as we mentioned earlier in our discussion, that 95% of the startups fail. So these are 5% who win. So they are actually looking out for those one or two successes in their entire angel investing careers, which actually makes everything for an investor. So yes, they are aware of the risk. Whenever they invest in a startup, angel investors are aware of that risk, and higher the risk, higher the reward. They are the ones who reap the highest reward compared to other stage investors like PEs or VCs. What factors we should consider while asking for valuation from investors? Look, you need to understand your valuation first before asking them, right? You need to understand the market. You need to understand what relative matrices are going on, what other industry players are, valued at or trading at, what are your peers trading at or valued at. And given that, whether it is in the domestic market or in the global market, if the comparison is not there in the domestic market, you look out for a relative analysis with a international player and in the international industry. Once you see how they are getting valued and traded, you understand your values as well, because you understand your matrix as well. So you need to understand what valuation you would be able to command given your numbers when you are comparing it with your domestic peers or global peers. That's when you start the discussion with your investors, because investors might come up with their own set of multiples, but you need to understand what multiple you should be valued at. Can you give an ideal example of exit strategy? Okay, so exit strategy comes after the mature stage funding, right? That's where most of the P funds invest. And those are sometimes stages wherein they do the complete buyout for a company which is not doing well, for reviving that company and taking that company for a merger and acquisition. So the best the example of exit strategy is, what is your plan for either going for IPO or mergers and acquisitions? If you think merger and acquisition, which kind of company would you think would be able to come and acquire you or merge with you? Which other large industry player you will look up to for the mergers and acquisitions? So these are the strategies which you should have in your mind. Can you Did I miss something? Can you touch upon some of the key things to watch out for in the term sheet? So also at the seed stage, it is mandatory to have a shareholders agreement. Yes, at every stage, it is mandatory to have a shareholders agreement. That's when you will bring the angel investors on board if they are investing in your equity. If they are investing in the debt, then the type of agreement would be different. If they're investing in convertible notes, then the type of agreement would be different. But if they're investing in equity, there has to be a shareholders agreement for that. Key things to watch out for in a term sheet. A quick answer to that would be just see the discount factor, which you are, as a terms and conditions, you are including for the next round of participations for them. And always see the ROFR, terms and conditions for that. I think I pretty much covered all the questions.
Yeah.
Dr. Sambit, is it covered?
Yeah, everything is covered right now.
Sure.
Then one thing is that one is last query. We can put it your pitch for the session was super smooth and flawless. Thanks for covering the practical aspects at different stages in the startup journey. And we look forward for the following follow-up sessions covering certain aspects on more startups.
Sure.
With this, we are thankful to you, ma'am, for deliberating upon the various aspects of the pitch deck. We are also thankful to touch upon the various aspects of that one is particularly the investor point of view. With this, we are thankful to our today's speaker, CA Jia Diwan, for her nice deliberation, and that one is particularly covering the all aspects of the pitch deck. We are also thankful to all the participants of this virtual CP meeting. With this, we conclude today's virtual CP meeting. Thank you to all.
Sure. Thank you, Dr. Sambit, and thank you everyone for listening to this experience of mine.
Thank you to all. With this, we conclude the session.